Welcome, dear students, to our second chapter, Mutual Funds, Investments for the Masses. One of the problems when you are teaching investments is the decision you must make regarding whether you should teach mutual funds before stocks and bonds or after stocks and bonds. And there are advantages and disadvantages to both choices. We are going to put mutual funds first. Why? Because they're so important for the vast majority of us. Many people will decide that, you know what, this picking individual stocks, picking individual bonds, it's not for me. It's a lot of work, and I don't really enjoy it. That's why there are mutual funds. Yippee! Plus, chances are you're going to see these things when you get a job at a business or a governmental organization or a nonprofit organization that has an employer-sponsored plan, such as a 401k or a 403b plan or a simple IRA. And 99.99% of the time, the choices will be mutual funds. Plus, the sad reality is that we're going to lose a lot of students. And for whatever reasons, so we want to hit them with mutual funds before they leave us. Okay, so let's get started with a wonderful saying that you don't hear too often anymore, but I think it's very, very apropos for mutual funds. Mutual funds will bore you to wealth. Not bad, huh? Yeah, indeed. They're not exciting. Well, some of them are, but most of them are pretty lame, tame, and not as exciting as your stock that went up 20% in one day and then went down 30% the next day. Oh. So let's get started. Slide number 2. What is a mutual fund? Well, we have done the overview of investments. So you understand a little bit about stocks, a little bit about bonds, and a little bit about mutual funds. So let's review. An investment company, a mutual fund is an investment company. That's the legal term, by the way. A mutual fund is the popular term, and that's what you'll hear people say. But if you work in the industry, you'll hear people use the term investment company. An investment company that invests its shareholders' money in a diversified portfolio of securities. As we said, investment company is a legal term, mutual fund is the popular term. You get 2 wonderful benefits: professional money management and instant diversification. And each fund has a specific investing objective. There are approximately 12,000 mutual funds. Oh my goodness, that's 6 times more than the number of visible stars in the sky. Well, how did that happen? Hang on a minute. We're going to go through the entire chapter and see by the end that, oh my goodness, the mutual fund industry has just exploded. And as we made mention, many people choose mutual funds for the retirement account investments, IRAs, Roth and traditional IRA, 401k, 403b plans, which is why they are so important. Slide number 3. Here is my wonderful graphic. Oh, by the way, I'm currently writing the textbook to accompany this class, and I could sure use somebody who's savvy with graphics if you want extra special bonus points, which aren't worth anything. But hey, I'm not getting paid for it either, for the textbook either, so there. I did this. Aren't you proud of me? I'm great with those stick figures and that little curvy thing. Looks like a straight line, but then you can make it into a curve. And here we are, folks. We're the little people, and we're giving our money, $50, $100 a month, to the people in the top hats, and those are women, folks. I know. And hey, more and more women are deciding, you know what? I'm not counting on the man of the house to do the investing. They saw their grandmother do that, and he said, I'll take care of you, my wife, and then he never put away a dime, or if he did, he blew it off playing the loser's game. And so then he died, leaving her in the lurch. So the younger women are saying, no, soy yo, that's not me. And so we give our $100, $50 a month or more if we can afford it through our paycheck, through our checking account to the people with the top hats. And they're the professional money managers. And more of them are women, folks. Why? Because it turns out, it's already been statistically shown, empirically, women are better investors than men. Now, I'll leave it to you to decide the reasoning behind that. I'm not even going to touch that topic. All I can say is it's already been shown that women do better than men. I have my own reasons, which we may discuss later on, but that doesn't mean I'm right, because how do you prove that? They create a pool of money, and I know it kind of looks like a potato, my apologies, but that pool of money is called a mutual fund, and we know it to be an investment company legally. Now, there are other types of investments that are investment companies, not just mutual funds, but by far mutual funds are the most popular type of investment company. And if they buy the stocks, they don't buy 5 or 10, they buy 100 or 200 or more. And that's called a stock mutual fund. So if one company goes belly up, it's not the end of the world. Whereas if you only have 5 companies, yeah, right. If they buy the bonds, it's called a bond mutual fund, and they buy 100 bonds or more. If they buy the short-term cash, we talked about that in the previous chapter, right? Investments such as treasury bills and commercial paper and the like, bankers' acceptance notes, then it's called a money market mutual fund. But usually the money market is all that you see. You don't see the mutual fund after it. And we begin to see the explosion. We begin to see the balkanization. You like that word? It means splitting up into little pieces of the mutual fund industry, because there are balance funds that invest in both stocks and bonds. Just the tip of the iceberg, folks. So stick with us. So you like this graphic? It's yours. And if you can do better, please contact me. Let's take a look at the growth of the industry. In 1940, there were already 70 mutual funds. See, these things started in the mid-20s, 1920s. They were copies of the Scottish Investment Trust, right? Scottish, there's a name for it. It's still in business. And at first, the regulators in the United States were scratching their heads and saying, I don't know about this stuff. What's going on here? So the demagogues and the Republicans got together and played nice in the sandbox. And in 1940, they created the Investment Company Act of 1940. And it's been modified somewhat over the years, but it has served the public very well. Indeed, it shows that they can play nicely in Washington when they put their minds to it. 30 years later, there were 350. By 1980, there were 600. And look at what happens between 1980 and 1990, 2,000 mutual funds. And then the go-go 1990s, the internet mania bubble, which eventually burst in 2001, 2002. We went from 2,000 to 9,000 mutual funds, and we're currently, as of the end of 2020, sitting at little under 12,000. Where do you find this information? The Motherlode, the Investment Company Institute, ICI.org. It's a nonprofit trade organization, and every year they come out with their fact book in May or so for the previous year, and it is just chock full of unbelievable information. Very, very, very much fun for those who just love statistics. Statistics. So we see that the industry is immense. In 1980, 5 million Americans owned mutual funds, holding just 3% of their household financial assets. As of December 2020, it was 105.3 million Americans in almost 61 million households. That's almost 50%, 47.4% of all U.S. households, totaling almost $30 trillion, holding 23% of the household financial assets. Mutual funds are now the nation's largest financial intermediary. That means they hold on to somebody else's money, followed by commercial banks in second place and life insurance companies. They're often called the invisible bankers. Again, you find all this good information in the Investment Company Fact Book for 2021. That it came out in May and covers up to December 2020. So we'll take a longer view and go back to 2007 and see that in 2007 there were $13 trillion in mutual funds. And what happened in 2008? Ouch. Now, wait a minute. Didn't the market lose about 50%? Yes, it did. But we have to remember that there's a few $1 trillion sitting in money market accounts. And do money market accounts go down? No, well, every once in a while they break the buck. They lose a penny, but no. So it wasn't as bad as it could have been. But the stock mutual funds, some of them lost well over 50%. But then we see the industry coming back, and looky there. By 2020, at the end of 2020, we're looking at 29.6 trillion with a T. And folks, you and I cannot even phantom. We just cannot phantom these numbers, trillions of dollars. It just doesn't make any sense. Notice in 2018, right at the end of the year, Christmas Eve, it was the big down day. But we saw the industry continue. Now notice, it doesn't look like 2020 was that bad. In fact, it went up. But do you remember? Right. Hope you didn't sell during the panic. The fastest bear market in history, and then the fastest recovery, all in 2020 as we put the economy into an induced coma and now are doing our best to bring it back. And that stupid microbe. So is the industry immense? Indeed it is. What are some of the advantages and disadvantages of mutual funds? Because I hope you're starting to understand that no investment is perfect. Every investment has advantages. Every investment has disadvantages. And the advantages of mutual funds, what we want to burn into the back of your eyelids, so that if I called you up at 2 a.m. in the morning and said, what are the advantages of mutual fund? I want you to say, diversification and professional money management. Okay, you got it? Okay, burn. Now, I'm not going to do it. Don't worry, I'm not going to call you up. But pooled diversification is a process where investors buy into a diversified portfolio of securities for the collective benefit of the individual investors. This variety provides some safety that is difficult, but not impossible, for an individual investor to obtain on their own. And then we get professional money management. The mutual fund managers are supposed to know what they're doing. They're certainly getting paid well enough. And there is controversy, as we will discuss, about whether or not they're actually worth what they are paid. And so we'll deal with that debate. Then a couple other aspects that we don't often talk about is the low initial outlay of capital. That's a fancy way of saying you can start it with $20, $50, $100 a month, right? People say, well, I'm going to get started buying stocks. So I'm going to, maybe I'll wait till I get $5,000. Who has $5,000 lying around the house, right? Get started now with $50 a month. How much is your cell phone payment? Right. And then I wish I had come up with this. The Wealthy Barber, one of the best financial planning books ever written. It's a little out of date. Mr. Chilton has sort of, retired and hasn't really kept it up. The numbers are wrong, but the concepts are brilliant, and he has even worse jokes than I do. So that's saying a lot. He came up with the PETA factor, which is brilliant, right? Pain in the yeah, right. It is true. Once we have chosen a mutual fund, or maybe one or two, maybe a couple to start, they're already pretty diverse. Then there's really not much for you to do. Just make sure the $50 is in your account before it, automatically is withdrawn, or make sure your company pulls out the money out of your paycheck. Because after you've chosen the mutual fund managers, they do all the work. Right. They're getting paid, right? What are the downsides? Slide number 8. What are the drawbacks? Well, it's not free. The mutual fund industry is not a non-for-profit organization. That's why there's so many of them. There are transaction costs. Some have a sales load, a sales charge, a commission that we'll discuss in detail. Others are no-load funds. Well, that's great, right? They don't charge a commission. That's what I want. Whoa, 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 whoa. You got to look at the annual operating expenses. Because over the long term, assuming you're a long-term oriented investor, which is why we're taking this class to learn how to be a prudent, long-term oriented investor with an eye toward growth and income, you have to look at the annual operating expenses because those are going to be the biggest over time fee for you. And what another drawback, as we said, is many mutual funds actually don't match the market's performance. Wait a minute. Aren't the mutual fund managers supposed to know what they're doing? Well, some are quite good and have done well over decades, and some are not so good. And our job as potential mutual fund investors or as future mutual fund investors is learn to identify high quality, well diversified, well run mutual funds that have done well in good times and bad times, folks, because you know what? The bad times come. We don't know when. We know history tells us they're going to come and they're going to go too. They're going to live through it. And so we want to look at mutual funds that have done well in good times and bad, in my humble opinion. Now, most people have no idea that there's such a thing as a closed-end fund. This is an introduction to investments class, and some of you are going to go in the industry, so you need to know, and maybe you decide for yourself that hey, I like these closed-end funds. For decades, there were two types of funds, open-end and closed-end. There's now a new type called an ETF, exchange-traded fund, that we'll take a look at in a few minutes here. By far, the largest majority of mutual funds and the greatest amount of wealth is in open-end mutual funds, about 76% of all mutual funds. This is a type of investment company in which investors buy shares from and sell them back to the mutual fund itself. There's no limit on the number of shares the fund can issue. So when you invest in a mutual fund, you're actually buying shares. And it's a little tricky for some people. They go, didn't I put in $50? Yeah, you did, but those $50 were translated into shares. And it shows up on your statement, which many people don't really understand, so they kind of ignore it, especially if you can sign up for email delivery and then delete the email. Shares are issued and redeemed by the investment company at the request of investors. Investors can buy shares from, purchase, invest, and sell shares back to, redeem, withdraw your money, the investment company at any time. When people refer to a mutual fund, they are almost exclusively referring to an open-end mutual fund. If they don't say open-end mutual fund or closed-end mutual fund, they're talking about open-end mutual funds. As of December 2020, there were over 9,000 of these things, holding almost $24 trillion out of that, 30 trillion. So by far, open-end mutual funds are the largest number. You'll hear people say that their days are numbered, by the way, that open-end mutual funds are going to disappear. I don't think, maybe someday, someday the earth is going to end, but I don't know when. It's not going to happen anytime soon. The next type, as we said, were closed-end mutual funds. And notice there's only about 4% of all mutual funds. And these guys are shrinking, by the way. This is a type of investment company that operates with a fixed number of shares outstanding. So the open end, you want more shares, you send more money to the mutual fund company, they create more shares for you. You want your money back, they destroy those shares. You purchase the shares and then the shares are redeemed. But with a closed-end mutual fund, when they started up the mutual fund, they said, okay, we're going to have 10 million shares. And that's it. The shares are issued by the investment company only when the fund is organized. After all the original shares are sold, then you could only purchase shares from another investor. This is how stocks work, and this is how bonds work. You buy and sell them on the open market. So you have to go through your broker. You have to go through a broker. You can have these self-directed brokerage accounts where you don't even talk to a broker. Robinhood type places, and Schwab now, and TD Ameritrade. But you have to go through your broker. So you incur brokerage commissions, which, nowadays, oh, I'm not paying any commissions. Yes, you are. Next chapter. Closed-end investment companies are not as popular with individual investors as open-end investment companies. At the end of 2020, there were only 494 of these, holding only $279 billion. So the open-end, 24 trillion, closed-end, less than 300 billion. You see, the closed-end mutual funds are becoming less and less popular. The numbers are shrinking. That doesn't mean there aren't good closed-end mutual funds. They're just harder and harder to find now. And now, the net asset value. It's a fancy word for how much is the mutual fund worth. It's the underlying value of one share in a particular mutual fund. Every day that the market is open, the mutual fund company must perform this task. They have to add up the value of the securities, the stocks, the bonds, or whatever they're investing in the mutual fund. They then subtract any liabilities. Well, this is usually close to zero. They have to pay the rent. A few people have redeemed their shares. They have to pay them off. And then you divide by the number of shares. So you find every day, usually it's 4 o'clock Eastern time, so 1 o'clock our time is when the markets close. And then usually about 3 or 4 hours by the end of the evening for them, and if they're in New York, the end of the afternoon for us, they will publish what the net asset value, what is the mutual fund worth today. Open-end mutual funds are sold at net asset value with a sales charge if they have one. Since closed-end mutual funds are bought and sold on the open market, their price usually reflects a premium or a discount to the net asset value. And typically it's a discount. They're very rarely priced at their net asset value. So what does that mean? It's not a big difference usually. Maybe it's 25 cents less than the net asset value. But because they are subject to market forces, supply and demand, the closed-end funds aren't necessarily priced at what the value of the securities are reported as. Does that make sense? Think about it. Some people say, well, shoot, it's 25 cents less than it's worth. I'm going to buy it. But then when you go to sell it, it'll typically be sold for 25 cents less than what it's worth. Oh, well. Now, here's the formula that you don't have to worry about because it's done for you. You take the value of the fund's portfolio minus any of the liabilities, the bills that they have to pay, and divide that by the number of shares. So let's say the securities, maybe their stocks, are worth $10,050,000 and they owe $50,000 for rent and payroll and all the other things that they owe. That's $10 million. And they have 1 million shares that are trading hands that they issued to the public. And remember, they don't issue anymore. Once those shares are out, you have to buy and sell them to another person through the open market, through the stock market, through the brokerage firms in the market for the it's basically the exchanges. They sell on the stock market exchanges. So you have to buy them through your brokerage and sell them through your brokerage. So that's 10 million, 50,000 minus 50,000, that's 10 million. Divided by 1 million shares gives you a $10 net asset value. The offering price will be different if there's a sales commission. So let's say there's a 5% commission. We'll discuss that in detail in our next presentation. That would be 50 cents, right? 5% of $10. So the offering price would be $10.50 if it has a sales load, which we'll discuss in detail next presentation. Slide number 13. What are the advantages? What are the disadvantages of open-end versus closed-end? Well, open-end mutual funds are just very simple. They're very simple. There's always the ability to buy and sell. There's no market forces. They're very popular. There are, how many times more choices than closed-end. But this is something that you and I don't have to worry about. The management has to worry about it. Large purchases or redemptions can make the management of the fund difficult. Let's say a mutual fund, open-end mutual fund, does really well. People will start showering them with love and attention and money. And now all of a sudden, they've got money coming in the door they don't know what to do with. What do? They have to buy more shares of the companies they already have. Maybe that's not the smart thing. Maybe they can't. There's a restriction. We'll see. So what some companies will do is close the fund to new investors. You'll see some funds, if you go, especially Fidelity, you'll see, this fund is closed to new investors. So that's a bit of an issue. That's an issue for the investor. Oh my goodness, look, this is a really great fund. No, sorry, we don't want any more investors. And the same thing happens when the mutual fund doesn't do well. People start redeeming all their shares. Well, maybe not at the best time. Maybe the market's down. So now the open-end mutual fund has to sell shares to meet the redemptions, which maybe they don't want to do because the market's down, the worst time to sell. Where, see, that's not an issue with the closed-end mutual fund. The closed-end investment company doesn't have to worry about a big influx of money coming in or a big outflow of money coming out. Because once they've sold all the shares, it's up to the investor to buy and sell them from other investors. But the problems with the closed-end mutual fund, you got to pay the broker's commission like a stock. And yes, even if there's no commission, you're still paying a commission. Next chapter. There's that market force that we talked at, so they're often sold at a premium or a discount. But from the standpoint of the mutual fund company itself, the closed-end mutual fund is much easier to manage. Now, I ask which one do you or which one would you prefer? Chances are, most people are just never going to get involved with closed-end mutual funds. So that's your decision. But think about it. Some are quite good. Some have done very well for their investors. Now, the third type, the newer type, and it's about, almost 30 years old. They started in 1992 or so, 1993. Exchange-traded funds, ETFs. You'll mostly see it written like this, ETF. They are approximately almost 20% of mutual funds, and their numbers are growing. They are a hybrid. They're an open-end mutual fund that trades on the stock exchange like the closed-end mutual fund. So remember, the open-end mutual fund, there was no limit to the number of shares. The shares are issued as needed, but you had to buy and sell them from the mutual fund company. Maybe sometimes through your brokerage firm, but still, you went to the mutual fund company to buy them. Whereas the exchange-traded funds are traded on the stock market. They're traded on the exchange. So there's no limit. The company can add more shares as needed, but you go through your broker. Now, what does that mean? You're going to incur a broker transaction fee, maybe a commission, maybe another way of being being charged for the transaction. But some mutual fund companies, very smart, like Fidelity and Vanguard, they're very smart companies. They have found a way to eliminate the brokerage transaction fees. They've opened up their own brokerage firms. It's not the same company. I think it's called Fidelity Investment Services as opposed to Fidelity Management. But it has the same name, Fidelity or Vanguard. It looks they're sister companies. And if you purchase their ETFs through their brokerage firm, hey, they waive, WAIVE, the commission. Very smart marketing. ETFs have become very, very popular, and we will discuss why later on for various reasons. Look at the growth of the ETF industry, and I'm starting to get to the point where it can't fit on one slide, so I'm going to have to maybe next time I'm going to have to go every other year. But look, 2006, there were 359 of these things with $423 billion. And then in 2008, look, the numbers still kept going up of funds, but the dollars went down. But look at throughout the 2010s, oh my goodness, now there are almost 2,300 ETFs with $5.5 trillion. So you'll hear people say, oh, open-end mutual funds, they're all going to be good. They won't even use the term open-end because they don't know there's a difference between open-end and a closed-end. But they'll tell you, oh, open-end mutual funds are all going to be gone. It's only going to be ETFs. Yeah, as Mark Twain said famously, the reports of my death have been greatly over-exaggerated. But still, the industry is exploding. ETFs are becoming more and more popular for various reasons. So now, how are mutual funds regulated? So we'll spend a little time discussing what these things are, how they are watched over, how they are regulated. It goes back to the Investment Company Act of 1940. Even though there were mutual funds before that time, the Investment Company Act set the world of mutual funds in stone. They defined a regulated investment company, there's the legal term, right? Investment company, as a pass-through investment vehicle. You see, when you make money, the IRS says, ooh, excuse us, we're Uncle Sam. And then the state says, ooh, we're Uncle Cal. Let's talk. But the mutual fund company said, no, you don't understand. We're making the money on behalf of our shareholders. And the regulators scratched their head and said, huh? And so that's why we needed the Congress to act. So now the mutual fund just says, look, we pass through the investment rewards, the dividends, the reinterest, the capital gains. We pass them through to our investors. So they're the ones who pay the taxes. Oh, okay, I understand. That makes sense. Okay. To qualify as an investment company, the investment company must hold almost all of its assets in stocks, bonds, and other traditional securities. There used to be a very limited ability to use derivatives and other risky strategies, and I hope you never do get involved in these things, folks, but you see more and more mutual funds doing this, and how they get away with it, I'm not really sure, and I really don't even want to know, because they are not in your best interest, in my humble opinion. I wouldn't touch these things with a 39.5-foot pole, but other people might say, oh, yeah, I want to have that 3 times go up and 3 times go down mutual fund. Use no more than 5% of its assets when acquiring a particular security. Now, what does that mean? Look, 5%, you divide 5% into 100%, that means 20. You have to have at least 20 stocks. If you're a stock mutual fund, at least 20 bonds. So you see, they're enforcing the diversification. Now, 20 is not a good number, folks. We like to see at least 50, preferably 100 or so, because we want diversification. But the law is saying you cannot put more than 5% of your assets into any one individual stock or bond. Now, what happens if the stock does really, really well? And it's no longer 5%, now it's 10% or 8%. The mutual fund company doesn't have to sell. They're not required to sell the shares, but they can't add any more. And I remember a gentleman by the name of Donald Draymond, who he's long since retired, but he had the Draymond, it was a very popular fund, named after himself. He had a couple, actually, but the one I remember, because one of the folks at the brokerage firm I started working at was very popular. It was very popular with him. And he had 12% in one stock. And he wasn't selling. He was so happy with that stock. He said, I'm sticking with that stock. And I thought, oh, well, he did really well for his shareholders. But then he retired and they sold it to somebody else, and I lost track of it. And they have to create an organization with checks and balances. Now, you've heard of checks and balances, right? That's your civics class. That's what our government's supposed to have. Somebody's supposed to be watching over each other's backs, the Congress, the executive branch, and the judicial branch. And then we have the fourth estate, the press, the media. It doesn't always work like the way it's supposed to, does it? And the same thing is true here in the mutual fund industry. Here are the checks and balances. And I don't know. Again, I'm not very good at this graphic stuff. But at the base of the organization are the shareholders. And they support, maybe there should be a line up here or something, but the shareholders are the reason that the mutual fund's in existence, right? And so they're the ones bringing in the money. And then there's a board of directors that oversees the mutual fund. They are acting on behalf of the shareholders. They have to have at least 75% independent of the organization. Now, in the past, and of course, probably nowadays too, there are accusations where the board of directors were just a rubber stamp organization. But many people will tell you that most boards of directors take their job seriously and do their best to watch over what's going on with the mutual fund. And then the mutual fund itself is a corporation made up of various components. By far, the most important is the investment advisor. That's the management company. Those are the people with the top hats. They manage the fund's portfolio according to the fund's objectives. This is a stock mutual fund. It's an aggressive stock mutual fund. We'll discuss those in a couple of presentations. So they're the ones who are making the investment decisions. But do they actually hold on to any of the money or the shares? No. A custodian, another company, is the company that actually holds the financial assets. They are managing them separately to protect shareholders' interests. And one of the reasons there are so many different mutual funds is that you really only need the investment company, the investment advisor, to start up, because these other tasks you can source out, you can contract out. There are companies that just do custodial assets for you. They're usually banks or big trust companies. Then there are the distributors that sell the shares to the public directly or maybe through brokerage firms. They're called the distributors. The transfer agents actually process the buy and redeem, the purchase and the redeem shares. They're the ones who actually are dealing with the day-to-day transactions. And then there's an independent public accountant firm, I think there's big four now: Deloitte, KPMG, Price Waterhouse Cooper, Ernst & Young. I think it's called Ernst. But these are the big. There used to be more of them. The big accounting firms that come in and say, okay, you say you have 100,000 shares of Apple. Where are they? Oh, okay, they're here with the custodian. And the custodian shows. By the way, you might have heard of Bernie Madoff. His accounting firm that did his audits was a guy in Connecticut who did it in his garage. Yeah. No, mutual fund companies don't try that stuff, folks. They don't. Maybe there's one fly-by-night organization out of 12,000, but most are very, very reputable. So the next two slides just go over what we've just described. The corporation run by the board of directors. The board of directors are voted in by the shareholders. They oversee the fund operation on behalf of the shareholders. The investment advisor, the management company, the money managers have portfolio managers that make the decisions. Sometimes it's a team, sometimes it's a committee. There's a difference between a team and committee. I'm a big fan of teams. They work together as a team, but they make their own decisions. And then all of them will have what are called research analysts that focus on a specific industry. Some firms let their research analysts actually handle money. Others say, no, you got to become a portfolio manager before you handle money. The custodian is the company that actually holds on to the securities. As we said, it's often a bank or a trust company. The distributors, they distribute the shares to the public or to dealers, much the same role as an investment banker, which we'll discuss when we get to stocks. Mutual funds are technically continuously initial public offerings. And initial public offering is the first time you sell shares to the public. Well, mutual funds are always selling shares to the public. So they're basically a continuous initial public offering. Now, the transfer agents keep track of the purchase and redemption requests, as we said, from shareholders, and then the independent public accounting firm certifies the fund's financial operations and reports. So why? Why the large diversification of tasks and companies? Well, mutual funds are highly regulated in order to protect shareholders' investments from fraud and collapse. How often have you heard of a scandal at a mutual fund company? Well, I think you go back to 1970 or something like that. One guy, a very small money market fund, I think he ran away with $4 million. He went to Cuba or something like that. And then until 2003, you never heard of any scandals. Wait, whoa, wait a minute, Paiano. Did you just say mutual fund scandals? You want me to invest in an industry that is plagued with scandal? Well, yeah, as a matter of fact, I do. Since 1940, the mutual fund industry has been regulated and escaped virtually any hint of impropriety. You like that word, impropriety? Means hanky-panky. Trucos, travesuras. Yeah, in 2003, some practices that were not quite illegal, but obviously unethical, were uncovered. It was only a handful of funds, a handful of people, strong funds, Janus, Bank of Bank of America, Putnam, poor George Putnam, rolling over in his grave, and then Alliance. Alliance Funds is a very good company, folks. 2 people at the entire firm were involved in this hanky-panky. The worst one was Richard Strong. Built the company from scratch. At the time he did these things, he was worth, I don't know, hundreds of millions, $800 million, something like that. Read the book. It's in the book. And he made, $600,000 doing this stuff? Now, to you and me, $600,000 is a lot of money. But to somebody who's worth $800 million, it's pocket change. And he was very, very contrite, very upset, very sorry for what he did. He said, I ruined my life. I let down all the people around me. He was barred from the industry for life. And what were these people doing? Well, folks, it's a little, you look it up. It's in the book and there's all those links. You just type in mutual fund scandal of 2003. They were shaving pennies, hundreds of pennies off of the price of the mutual fund. Of course, if you have 1 million investors, that adds up pretty darn quickly, doesn't it? So instead of losing your entire amount, which is what people did if they had Enron or WorldCom, and some of you are too young to even remember them, but in 2001 and 2, Enron they didn't force people, but they really highly encouraged that their employees invest in their own stock in their 401k plans. And then when the company started going through its death throes and bankruptcy, they wouldn't let them sell the shares. So they lost $99,999.99 on a $100,000 investment and were left with a penny. Whereas investors lost much less than a penny on a $100,000 account. Was it wrong? Yes, it was wrong. Was it illegal? No, not really illegal. So nobody went to jail, but they were, as we said, barred, from the industry for unethical behavior. And remember, I want to emphasize that most companies had nothing to do with this. And when they heard about it, they were incredibly upset and angry. And rightfully so, because trust, this business is based on trust. Okay, so now, go back over, make sure you understand the difference between a closed-end, open-end ETF. Look at the growth of the industry. Take a look at the way a mutual fund is regulated. Because in our next presentation, we're going to discuss a very important topic, fees. How is the mutual fund charging its investors? And most people understand that they're being charged. They know it. They just don't really understand how. And you, dear students, are going to be their investment gurus. So you are going to explain it to them. And you are going to be awesome and speak with authority. And we're going to be so proud of you. Cool? Okay, so we'll see you in our next presentation when we go through the world of fees. See ya.